Welcome to Real Estate Radio Live, an informative and engaging podcast discussing everything you need to know about the world of real estate. Your host, Joe Caccera, provides you with insight and guidance on how to buy, sell, finance, and invest in real estate. He also offers real estate tax management strategies, new construction advice, home improvement tips, and much, much more. And now, to guide you around the world of real estate, here's your host and Real Estate Radio Live team leader, Joe Caccera.
Welcome in. Good afternoon. Joe Caccera with Real Estate Radio Live. Thank you again for those that are following us on Facebook. We appreciate that very much. We continue to grow the audience in the social media, and we try to do the best we can. And I want to just continue to thank those that follow us, give us comments. We got a lot of good feedback on a regular basis. So whether it's on the Facebook feed or whether it's on email or phone calls or text, thank you all very much for the great feedback and a lot of encouraging messages. I got a handful of great, really nice messages and emails over the last couple of days on some of the giving back segments we've done. So I appreciate that. We're going to continue to do that. Again, I'll throw it out there to the listening audience, those that download the podcast and follow our show. I'll throw it out there as an invitation to those that if anybody in your family, yourself, family, friends, coworkers, someone has a cause they're trying to really bring awareness to and they need some help exposing that cause and doing some good things, spreading the word, I allocate a certain amount of time for the show to allow people to come on, no charge at all, and we allow that as community service, and we're just really giving back as much as we can. So again, if anyone has any certain causes out there that we could help you spread the word, come in, call in, do a show, and help raise money, do anything we can to help many different causes. There's thousands of them, of course, and they're all good, and we'll continue to do our part as much as we can. Love to have you download the podcast, of course, any way that you watch the show, follow the show. We appreciate that very much. But the best thing to do is download the podcast. That way it's on your iPhone or on your device, so that way you could listen to the shows at your convenience. When it is good for you, you could go to iTunes and just type in Real Estate Radio Live, Stitcher, Google+, all the different places. You could also go to our website, RERL-1560-Creative.com. That is RERL-1560-Creative.com. You can get the podcast and download it there. All right, so the focus, as always, education and information. Today, I thought I would do a show on creative and alternative financing, and one of the primary reasons I want to bring this to the forefront today is that I've been wanting to do this for a while, but we've had several guests on, and we're going to have guests again tomorrow, so I thought I'd plug this in when I could. In a market where now it's switching a little bit from a seller's market to a buyer's market, now you're going to have more and more of a focus on, of course, buyers, and it's interesting, the market has slowed a little bit, which is kind of interesting, and I would call it more like taking a breather and settling in and really trying to figure out what we're going to do. October is going to be a big, I think, an interesting month when October is done to see how things fold out. As we wrapped up summer and went in September, kids are getting back to school, people are kind of getting settled, back into work, out of the vacation mode and, back into the swing of things, so to speak. And I think October will be an interesting month for the real estate market here in the Bay Area, and we'll see what happens for sure. But it is changing a bit from the seller's market to more of a buyer's market. And because it's doing that, I wanted to bring to attention and really bring to the forefront some different creative and alternative financing ideas a lot of people don't know about. I was just on the phone today with yet another client. I was walking him through the process of doing financing and doing cross-collateralization. In other words, using collateral on properties and also assets to leverage a purchase amount. And some people might be going, what in the world is that? So one of the reasons this is such a great, great program, and a lot of people don't know about it still to this day. I was on the phone with this client today to just give you a little bit of a background here. And they called me because one of the real estate agents asked them to call me because I do these cross-collateralizing loans a lot. I've done at least 12 to 15 this year, and I've done several. The year before was not that quite many, and they keep picking up. And the reason why is it's an alternative financing, and it's a strategy, and it's a short-term financing for people depending on if they're able to sell their house or leverage equity. So when I was on a call today with this client, she was asking me, she goes, some of the quotes I'm getting are bridge loans and hard money loans. And she went on to explain the bridge loans, which I'm aware of all those, by the way, but she went on to explain, so what she was doing is getting quotes for bridge loans. And so she kept asking me about this bridge loan we have, but ours is really not a bridge loan, it's more of a cross loan, and I'll get to that in a minute. So bridge financing is available. Probably more well known is bridge financing. Bridge loans, to get you a loan, to bridge the gap to that till you could, so there's different ways that investors do that when they're doing the bridge loans. And the problem with those, if you're familiar with them, is they're expensive. And they're a lot more expensive than the cross-collateralizing loan that I do, and I'm going to go through and kind of compare those. So what happens with a bridge loan is typically the lenders and investors, I should say, that do these bridge loans are what's called hard money, private money lenders. What that means is the interest rates are always going to be a lot higher, the fees are always going to be a lot more. So to give you an idea, if someone were able to get or negotiate a bridge loan with a hard or private money lender, okay, let's say you're leveraging one property temporarily and you're trying to buy another property. That's the scenario, the example I'm going to use today. So you have a property over here and you have a lot of equity in it, but you don't want to sell that property until you get in the contract and buy this other property. It's tricky, but this could be done. We do it all the time. So really one of these private financiers or hard money would say, okay, you have plenty of equity in your exiting property. We could leverage that equity for your down payment, a partial down payment, and then we could finance the new property. So again, I'm just using an example. So let's say you're trying to finance a new property of $2 million, and the property that you're leaving is worth about $1 million, and you owe very little, maybe a couple $100,000 on it. So there's a lot of equity in your exiting property. The key to doing something like this is you have to have a property that has a lot of equity. What's a lot of equity? At least 50 to 60%, and it's probably you need more than that. It's probably more like 60 to 70% equity in that. You want more equity than you want liabilities on that property if something like this is going to work. So what the bridge financing does is they look at that exiting property and say, great, we have plenty of equity there, so we're going to leverage a percentage of that equity. So let's say we're only going to require that you put 10% down on this $2 million purchase, okay, $200,000, and we're going to finance the rest. So we're going to finance the $1.8 million, and we're going to do a bridge. And the way we're going to do that is we're going to temporarily leverage the equity in your exiting property. So they're lending them $1.8 million. They're bridging. So the costs are going to be something like this, and I could tell you. The interest rates are probably going to be 9-10%, probably, interest only. And they're probably going to pay at least 2 points and maybe 3 points. So if you're financing $1.8 million, 1% or 1 point cost on that would be $18,000. So if you're talking 2 points, and 2 points would be the minimum usually. So you're going to be paying $36,000 just in origination points, just in the points. That doesn't include any other closing costs. $36,000 up front out of your pocket to finance something like this in a bridge loan. And that's minimum 2 points. Sometimes it's 3. And you're probably going to pay 9 to 10%. Maybe it could get a little more competitive. It could get down to 8%. But 9 to 10% typically interest only on that money. Well, that's expensive, but some people still do it because they figure it's their only alternative. And they look at this and they think, you know what, I don't want to lose out on this house. I understand that's an expensive fee. I understand it's a high interest rate, but I'm okay with that because I don't want to lose out on this house. So they go through with them. There's no right or wrong. There's no good or bad. It just depends what is right for each individual. I say that all the time. So that is a bridge loan. Any kind of traditional bridge, private, hard money financing is always going to be somewhere in the 8 to 10%, maybe higher interest rate. And you're always going to pay at least 2 points and sometimes 3. So that's the bridge loan, to give you an idea what this client was talking to me about. And she had gone through and talked to me a little bit about what that fee structure was. So then I went on to explain to her that we could do a cross-collateralizing purchase transaction for her. And we avoid the bridge loan, and it's a lot better, and let me explain why. So here's how the cross program works. It's similar to a bridge, and some people would say it's kind of a combination of a bridge, but it's different. So the way it's similar is that the investor on a cross-collateralized loan still does look at the exiting property to leverage equity as part of the down payment. So that part's the same. So let's look at the same scenario that you and I just looked at on the bridge loan, and we'll do a comparison. So on this cross program, this is how it would go for me and the investor I work with. So we would look at it the same. We're going to say, perfect, you got enough equity in your exiting property. We're going to require only a 10% down payment temporarily, and we'll finance the $1.8 million. Perfect. All right. That is all the same. Here's where it's different. Where it's different is, first of all, the rates are a lot lower. You're looking at interest rates probably in the high 5%, 5 3/4, 5 7/8, 5 3/4, and 5 7/8. Still high for conventional financing. Remember, this is not conventional financing. And it could be interest only as well, so we're good there. So again, you're looking at interest rates in the high 5% range, somewhere probably around 5 3/4 to 5 7/8. So you could see the interest rate already is much better. However, the big difference, certainly interest rate is a huge difference, several $100s less in payments. But here's the difference. The program that I just described, the cross-collateral program, has no points, 0 points, standard closing costs only. So look at the comparison. I could do the same transaction for that client. Instead of bridge financing with a private hard money lender, they come to me with my investor, and I could do a cross program that's in essence the same and save them. In this situation, it would be $400 to $500 a month cheaper on the payments, okay, and not paying the $36,000. So imagine that. So you're saving $36,000, and if you keep that loan for an average of 6 months until you sell your house and then get out of this loan, that's another, $2,500, $3,000 minimum. So this is a $40,000, conservatively, this program that I just proposed as a comparison to the bridge loan that this client was on the phone with me today. The program that I proposed does the same thing, but saves her $40,000, a minimum of $40,000. That is a lot of money on that purchase transaction. There's a lot of variables that go into it. I'm not going to get into the major details because I'll probably lose people because it's not super exciting, but there are some intricacies that go into this. But all I can tell you is that if you're listening to this podcast or you're watching, and you, someone you know, coworker, friend, family member, whatever, if you're trying to buy a house and you're trying to do that before you sell your home, give me a call. I could walk you through it. I'm not saying it'll work for you, and I'm not saying you have enough equity to do it, but a lot of people are surprised when we get on the phone or meet in person and I go through the numbers with them of how this really makes sense for them temporarily if you're trying to buy a home before you commit to the sale of your home. Now, sometimes with some people that make them very nervous. They may not want to do that just because the virtue is they're holding a larger loan. It's a temporary loan. That makes people nervous. A lot of people would say, oh, my God, Joe, the idea of buying a home before selling my home, I don't want to do it. And I get that. I understand that. I respect that. This is not for everybody, but it is for people that are interested in really doing something creative. All right, here's what I'm going to do. I'm going to take a quick break. And just for a minute, for those that are following us on Facebook, stick with us. Just a minute or so. I'm going to take a quick break. I'm going to come back. We're going to continue talking about creative and alternative financing. It's changing to a purchases market, and we're going to see if we could help some people get a little creative with their financing. This is Joe Kuchera with Real Estate Radio Live. I'll be back with you to continue in just a minute.
For more information on today's program, visit RERadiolive.com. That's RERadiolive.com.
Getting ready to buy or sell a home in 30, 60, or 90 days? Check out BundleSelect.com to find out how you could save 20% or more on your entire transaction, real estate, lending, and title. With BundleSelect.com, technology and a personal concierge are at your service to save you time and money. BundleSelect's hand-picked team of experts will compete for your business so you'll save thousands of dollars by bundling real estate, lending, and title services. BundleSelect.com gives you all the control, including using your own realtor. I'm Joe Kuchera with Real Estate Radio Live, and I have been on the radio educating consumers for years. I'm here to tell you BundleSelect.com is the best way to save money on real estate. By bundling services, you could save tens of thousands of dollars. This savings model could save you money on your move, lower your interest rate, or cover your closing costs. Visit BundleSelect.com. That's BundleSelect.com.
The estimated minimum savings are based on a comparison with the national average. Individual results may vary, and the estimated savings are not guaranteed. Bundle Select Inc. is a licensed real estate broker. California Bureau of Real Estate Broker license number 004666902.
Welcome back to Real Estate Radio Live. For more information on today's topic or guests, just visit RERadiolive.com. That's RERadiolive.com. Again, your host for today's edition of Real Estate Radio Live, Joe Kuchera.
Welcome back in. Joe Kuchera with Real Estate Radio Live. Today I am talking about creative and alternative financing. That's right, creative and alternative financing. This is specifically for people that want to be a little more educated on, I'm trying to finance a home. I'm trying to figure out how I purchase this home without selling my home first. And we do it all the time. We do it on a fairly regular basis. I was referencing in the first segments that I had a call today from a client that we're going to be helping him with a cross loan. And just to real quickly summarize that one, just an example, the traditional bridge financing versus the cross-collateralizing financing that I'm talking about that I do saved this particular client over $40,000. $40,000 in real costs. Not like $40,000 over the next couple of years or 30 years. No, $40,000 of real hard costs right now up front to finance, to pay the fees on that loan that they're not paying on my program. So I say this because a lot of people don't know that these other programs exist. Don't fall into the trap. If you're out there, if you're listening to the show and you're thinking about buying a home without selling your home, or you're not quite sure if you could leverage something, don't fall into the trap and automatically having someone tell you, this is typically the response you'll get when you talk to the average mortgage person or anybody else, or even a real estate agent. Seriously, when you say, hey, listen, is there any way I could buy this house without selling my house? I guarantee you 9 out of 10 people that you ask that question in our industry, not outside our industry, in our industry, they're going to say, no, you really can't do that. Or, you know what, if you do, it's hard money and I don't think you could qualify and I'm not sure if anybody does that. Here's what the answer should be when you ask someone like that. You know what? Yes, there are some creative ideas. I'm going to introduce you to some people I know that could help you. That should be their answer. So if you're getting the answer similar to, I don't think that could be done, it's hard money and it's too expensive, you don't want to do that, no one really does that anymore, keep seeking more and more information and do your due diligence. Yes, there's financing, there's creative and alternative financing out there. Now, here's another creative and alternative way that a lot of people don't know that could be done. The same way I just explained how we could use equity in a home to cross-collateralize. And again, for those that are familiar, if you just look at the word collateral, you're collateralizing against something. So in this case, we are looking at equity in a property. And let's say, see if I could spell this out or explain it as simple as I can. If 30%, let's say you're trying to buy something and there's a minimum of the requirement traditionally for 30% down payment. Okay, maybe this will explain it a little better. It's hard sometimes audio or, talking about this instead of writing it down in front of somebody. So let's say this transaction that you're trying to do requires a 30% down payment. But because you haven't sold your home yet, you only have about 10% roughly down payment. So then the investor says, no problem. You know that other 20% traditionally we would ask for? What we're going to do, we're going to use the equity in that home that you're exiting, or we could even use a rental property. We could use any other property that has plenty of equity in it. And what we do is temporarily leverage that equity to temporarily assist in that down payment so we can make this transaction happen. Someone might be going, well, Joe, that's invisible because they're physically not putting down the $300,000, right? Let's just use $300,000 for the number or whatever that number is. And I would say, well, yeah, I know it seems that way, but remember, they're putting a lien on this property for what in essence is at least 20% of that property or 20% of the down payment. So, yeah, they're physically not taking it out, but they're leaning against it for security of the financing they're about ready to secure. So This is really unique. It's creative, but I'll tell you, it works. And I've helped 25, 30 people in the last couple of years with this type of financing. Now, that's the cross-collateralizing of property. What a lot of people don't know, too, is you could leverage assets for creative financing as well. You could leverage assets. And there's a couple different ways you could do that. So let me explain that. Take a couple minutes. So the same way that I explained how we leverage equity in property, a lot of these investors will also look at assets and say, same thing, trying to buy a home without selling my home. And let's do that same scenario that I talked about. But let's say that you're not as fortunate. So the home that you're trying to buy, the $2 million home, but the home that you're exiting, let's say that you have a larger loan on that, or you don't have quite the equity. So the investor looks at the property and goes, oh, God, I wish I could leverage that property, but you don't have enough equity in it. Oh, gosh, what do I do? Well, do you have assets? Yeah, I have, $2.5–3 million in investable assets. Oh, really? Okay. So let's take a look at the category of those assets. And we could pledge against those assets and use those assets as collateral the same way we use the equity in the property to make this transaction happen. That's right. So just like the example I used, that we cross-collateralize and use equity in that property to temporarily put financing on and make this happen, we could do the same thing with someone's assets and pledge in essence, you pledge those assets temporarily, right? You sign an agreement that says, I'm going to pledge $400,000 to $500,000. Now, you don't liquidate, you don't sell. I just want to be clear about that. Let's say you have, in a mutual fund, or let's say, even better, let's say in a money market account you have, $500,000. Or it's a non-retirement account of some sorts. And we need about $400,000 to $500,000 of leverage to make this happen. We could, as an investor, we could leverage and pledge those assets. And then so you sign an agreement that says basically there's a hold or a lien on those assets, okay? Again, you don't have to sell them. You don't have to move them. You don't have to do any of that. They stay right in that fund. They stay right in that account. It's just that they're leveraged the same way property would be to help finance this creative purchase that we're looking at doing. This is another way that you could creatively do some financing a lot of people normally wouldn't know about. So I want to continue to get the word out there. One of the reasons I wanted to bring this up, and I've shared this topic before, it's not new. Usually every 3 or 4 months I'll bring it back out. And the reason why I wanted to bring it back out today is because I see this as a super, super opportunity for buyers right now. Buyers, you could be really aggressive right now for the first time in 3 or 4 years. You'll hear me say this now for a while. Buyers, get out there. Get out there and make a move. Don't regret it. My fear is buyers are sitting on the sidelines right now going, oh, Joe, I don't really want to. I don't know. I'm nervous. I had a home sitting on the market for 30 days. No one's made an offer. I feel like there's going to be a softening in the market. I feel like there's going to be some pullback in the market. My answer to that, if I was doing a seminar or I was talking to a one-on-one or 100 people, it doesn't matter. I would say, if you really want that house and it's the right time for you or you and your family or whoever it is, then make an offer on it. If you think the market's got 10, 15, 20% to go, then make an offer 20% less. All they could say is no. All they could say is come back and negotiate. I was talking to a neighbor last night about this. We were discussing this, and my belief is that, and you've heard me say this before too, if you're about ready to purchase a property, and I don't care if it's an investment property or primary residence or second home, and you're pretty darn sure you're going to keep that property for at least 12 to 15 years in and around the Bay Area or a place like this that's, pretty robust, great job market, great place to live, strong business environment. I honestly think, there's no guarantee in anything. But if anyone, I don't even care at the peak of the market, we could give you examples. I could give you hundreds of examples of people that bought at the very peak of the market in here in Silicon Valley in 2007 at the peak of the market. If I remember right, I think it was like summer of 2007 before it just came crashing down. I could line up hundreds of candidates of people that could tell you that they bought at the very peak of the market in summer of 2007. And those people that have their house right now still, 96% of those people that have their house still, the values are 20% or more than it was at the peak of the market. That's right. Now, I'm talking specifically about the Bay Area here. I'm not talking about Central Valley or up further in Northern California. I'm not talking about Southern California. I'm talking about basically to Santa Clara County, San Mateo County, Alameda County, right in this specific area, the Greater Bay Area, San Francisco. So if your plan is to hold on to this property and have this property for at least 12 to 15 years, I don't think it really matters. I don't think you should stress too much if the timing's right for you. I'm going to preface this by saying if the timing's right for you. Now, if you're one of these people that says, you know what, Joe, there's no way. I'm going to wait till, I hear this oftentimes too. People say, you know what, I'm going to wait till the market dives or the market crashes, or I'm going to wait till, you know, it drops 20% or whatever equation or whatever math you use. I hear people say, I'm going to wait till there's a big pullback, and then I'm going to go in and buy because I want to get it at a good price. First of all, it's like the stock market. You're not going to really ever know when the bottom is here. You might know when it's on its way back up, but it is almost impossible to figure out where the bottom of any market is or any stock is, because by the time it gets there, you don't know, and you think it's there and it goes down a lower, and you think it's there and it goes down a lower, and then all of a sudden it starts coming up again, and where was the bottom, right? So be careful with that. Be careful with that when you're thinking about that. I'm not suggesting that no matter what, go out and buy a house right now. What I'm suggesting, if the time's right for you, you have the down payment, you want to sell your home, you need a bigger home, you want to move up, you want to move out. That's what I'm saying. If the time's right for you, I would do it now. I wouldn't wait unless you can or unless you don't need to do it right now. That's a different story. Also keep this in mind. If you're selling a home to go buy a home, you're going to make it on the other end one way or another. And some of you might say, what do you mean by that? Well, here's what I mean. When it was a hot seller's market, right, and things were going crazy, guess what? People were excited when they were selling their home because they got top dollar. But guess what happened after that joy? After the joy came over their face and the big giant smiles when they took all that equity and they got a premium price for the sale of their home, guess where that smile turned upside down into a frown? You know why? Because that same person that just realized the huge increase in the amount of equity they got out of their home because they sold at a premium because it was a dynamic seller's market, that same person now has to go out and buy a home in that same market. Does that make sense? They have to now take that money, and they now have to put their buyer's hat on. And guess what? Now they're going to have to go out and see what it's like to be a buyer. And what it was like to be a buyer in the seller's market was brutal. Let me tell you, the last 3 or 4 years, it was brutal for buyers. And that's why I encourage buyers to get out there right now and make your move if you feel like it, because it's a good time. You have some breathing room. You could actually make offers. You could actually have contingent offers. You could make an offer based on, you know, the sale of your home. There's a lot more flexibility right now. So my point behind this example is that the same person that got all that money for the sale of their home now has to go compete in a market where they're going to pay a premium as well. Does that make sense? Okay, so let's do the flip side now. So let's do the side where it's more of a buyer's market. All right, we're going to turn it around. Now it's more of a buyer's market. And let's say a seller was trying to sell their home for $1 million, and a year ago the market probably could have got them $1.1 million. Just example, because it was going 10%, 15% over, right? And let's say in a buyer's market right now, the seller puts the home on the market for $1 million, and it's on the market for 45 days. They finally get a couple offers, and they settle on an offer of $950. And someone might say, Joe, God, that very same house in the very same neighborhood, and that zip code, that same situation a year ago, it kills me because I just left $150,000 on the table. I just lost $150,000 that house would have sold for, or I could have netted a year ago in a seller's market. And I'd say, you're right, but are you going to buy a house? And they'll say, yes. And then I'll answer the question like this. The end game, it's going to be a wash. And here's what I mean. If you think that you sold your home for $150,000 less, approximately, than you could have got it for it in the crazy peak of the market, guess what? You're going to go out in the home that you're about ready to put an offer in and buy, and if it's going to be the same price or higher than the home you sold, I can guarantee you, almost guarantee you, that you will now pay $100,000, $150,000 less than that house than you would have paid for that house a year ago. Does that make sense? So don't get so caught up on 50% of the transaction. I always tell people, look at 100% of the transaction. Look at the buy and the sell side. Look at the sell and the buy side. Don't look at one and try to make a case for one, because it usually doesn't work. If you're in a seller's market, you're going to be jumping up and down, laughing to the bank with the money you're going to get, right? But then if you buy a house in the Bay Area, if you're right back in this crazy market, you're going to pay a premium. If you're in a buyer's market, you're going to have more leverage, you're going to have more options. You're probably going to get, a bit of a discount, or you're going to save some money because it's more of a buyer's market. And that's just the way it is. Right now, I'll say before I close this podcast out, the one thing that I really would like to see is these people, first-time home buyers, people who have 10% down, 5% down, VA financing, 100%. Those I would really, really strongly encourage you to get out there now and make offers. Because, in the last couple of years, anybody who put less than 20% down or some of these programs, you couldn't get in. The competition was too fierce. I'd love to see those thousands of people that had such a hard time getting in because they were putting less than 20% down to get out there now, and you can make that happen. I guarantee you can make that happen. And you could also make it happen with the creative and alternative financing I'm talking about today. And that does include FHA. That does include 10% down. You could get a 10% down without paying mortgage insurance. A lot of people don't know that. You can. The way you do that is you could split the loans. You could do a first and second loan. Some of the people out there, if you're self-employed and you're worried about, Joe, I'd love to be able to finance, but I'm self-employed and, I take advantage of my taxes, and my taxes don't show that much money, but I got good cash flow. It's just that I do, I write a lot off. I'd say no problem. There's programs out there. There's alternative programs out there. They're called non-QM. So non-QM is non-qualified mortgage programs, so they don't meet the standard guidelines. You're going to pay a little bit higher interest rates, but we could finance those that are self-employed, that show very little income on their tax returns. We could use bank statements. An average bank statement sometimes is income if you have cash flow but don't have the tax returns to prove the income. There's a lot of different things you could do, and that's why I wanted to talk about this creative and alternative financing today. And I'll just say that don't let anybody talk you out of it or discourage you. If you're thinking about selling a home and buying a home or buying a home, right now is a great time to do it. Is it expensive? Yes. But it's a great time to buy, not only because the opportunities are out there, but it's a better time to buy because you now have more opportunities in financing than you did a couple of years ago. A lot of this financing, ladies and gentlemen, did not exist a couple of years ago. So I encourage you to get out there, and if you're ready to buy and make that move. As always, if I can help anybody, if you're listening to this podcast or watching and you're not sure if you're getting the right information, or if you need to run some numbers by, or if you want to sit with me in person, you want to give me a call, you want to do a consultation, you want to run some numbers and figure out if any of this stuff works for you, if you could qualify, or if it makes sense, I'm here to help you with that. All right, this is Joe Kuchera with Real Estate Radio Live. Thanks again for tuning in. For more information, you could always go to RERadiolive.com. Until next time, take care. Have a great afternoon.
You've been listening to Real Estate Radio Live. For more information on today's program, visit RERadiolive.com. That's RERadiolive.com. Subscribe to our podcast. Discover more at RERadiolive.com.